Imagine an economy so confident it stopped asking questions. In the 1920s, the United States believed it had cracked the code of prosperity. It was called the Roaring Twenties for a reason. Factories were running at full speed. Electricity was spreading from cities into rural towns. Cars, radios, refrigerators, and consumer goods poured into homes at a pace never seen before. Advertising promised a future of comfort and convenience. The stock market became a national obsession, discussed in cafes, barbershops, and living rooms. Between 1921 and 1929, U.S. industrial production rose by more than 50%. Corporate profits soared. The Dow Jones Industrial Average quadrupled. Newspapers spoke of a new era, where modern technology and financial innovation would prevent major downturns. Economists claimed the business cycle had been tamed. Politicians promised permanent growth. America was not just rich. It believed it was unstoppable. They were wrong. Millions of Americans bought stocks for the first time, and many of them didn't use their own money. They bought on margin. Typically, investors only needed to put down about 10% of the stock's value. The rest was borrowed from brokers and banks. If a stock went up, profits were enormous. If it went down, the debt still had to be paid. This turned normal investing into a highly leveraged gamble. By 1929, more than 40% of stock purchases were made with borrowed money. Some estimates suggest that margin debt reached record levels never seen before. A rising market made everyone feel like a financial genius. A falling market would soon reveal how fragile that confidence was. Banks were deeply involved. They didn't just lend to investors. They invested depositors' money in the stock market themselves. Many banks were essentially speculating with the savings of ordinary people. Wall Street wasn't just a financial center. It became a machine that recycled optimism into leverage, turning borrowed dollars into rising share prices and rising share prices into even more borrowing. Then confidence cracked. In late October 1929, stock prices began falling sharply. At first, it seemed like a normal correction, but fear spreads faster than reason. On October 24th, known as Black Thursday, panic selling overwhelmed the market. Trading floors filled with chaos. On October 29th, Black Tuesday, more than 16 million shares were dumped in a single day. Prices collapsed. The Dow fell nearly 25% in 2 days. Within 3 years, the stock market had lost almost 90% of its value. But the stock crash was only the first domino. As prices fell, brokers demanded that investors repay their loans. Many couldn't. Banks that had lent heavily to speculators faced huge losses. When banks began to fail, people rushed to withdraw their money. Those runs caused even more banks to collapse. Between 1930 and 1933, over 9,000 U.S. banks failed. Depositors lost roughly $140 billion in today's dollars. Credit collapsed. Businesses could no longer borrow. Companies closed. Workers were laid off in waves. By 1933, U.S. unemployment reached nearly 25%. In industrial cities, it was even higher. In some places, 1 out of every 2 young men had no job. Families lost homes. Children left school to help their parents survive. Global trade collapsed by more than 60%. Countries raised tariffs, making the downturn worse. U.S. GDP fell by almost 30%. Prices fell so sharply that even people with money stopped spending, expecting everything to be cheaper tomorrow. That delayed purchases, which caused businesses to lose more revenue, leading to more layoffs. The downward spiral fed itself. This was not just a recession, it was a deflationary collapse. At first, the government did almost nothing. There was no modern central bank policy to flood the economy with money. There was no federal unemployment insurance. There were no automatic stabilizers. People were left to survive on charity, family, and local aid. Breadlines stretched through cities. Shantytowns, nicknamed Hoovervilles, appeared outside major urban centers. It took years before serious action arrived. The New Deal created public jobs, built roads and dams, stabilized banks, and restored confidence. Deposit insurance was introduced so people would no longer lose everything when a bank failed. Financial markets were regulated to prevent reckless speculation. Slowly, painfully, the economy began to recover. But the damage was permanent for millions. Homes were lost. Savings were wiped out. Entire careers disappeared. A generation learned what it meant to live with economic fear. People who lived through the Great Depression never forgot how quickly security could vanish. And that's the deeper lesson. The Great Depression wasn't just a story about stocks. It was a story about a financial system built on borrowed money, blind optimism, and the belief that risk had been conquered. The crash didn't create the weakness. It exposed it. When that belief collapsed, the losses didn't fall on the people who had inflated the bubble. They fell on workers, families, and communities who had no control over the system that failed them. The system survived. The market recovered. But the cost was paid in lost lives, lost futures, and lost trust. That is what a true financial crisis looks like. And history has a habit of repeating itself whenever confidence once again outruns reality.